As we started to see in the first video, implied volatility can be used in a variety of ways when trading options. In this video, we want to focus more specifically on one of those ways, calculating the expected move of a stock. In other words, based on a stock's IV, we are able to forecast its anticipated range of stock price movement. In general terms, if stock ABC has an IV of 20% over the course of an expiration cycle, and stock XYZ has an IV of 10% over the course of the same expiration cycle, then the market is anticipating twice the potential movement in ABC compared to XYZ. Of course, ABC and XYZ will be trading at their own unique prices, so the actual dollar values of these estimated ranges could be quite different. Still, given where a stock currently sits, the implied volatility, and the time until expiration, we can compute the likely range of prices over that time period, i.e., the expected move. Of course, this is merely an estimate and literally anything can happen, but approximately 68% of the time, stock prices will fall within this range on average. For example, let's look at Apple. At a price of $170 and an IV of 25%. Over the next year, the expected move is simply plus or minus $42.50, or 25% of $170. But if we were to focus on only the next 45 days to go in the current expiration cycle, the expected move would shrink down to plus or minus $14.90. In other words, over the next 45 days, the market is expecting Apple to move in about a $30 range, almost $15 up and almost $15 down. We can use this formula to adjust our traditional annual implied volatility to any time frame we want. Pretty cool, right? Now, market randomness and unpredictability dictate that this anticipated range will always be symmetric, with an equal chance of an up move relative to a down move. Hence, expected moves will always be given in a plus-minus format. The expected move derives its name from the normal distribution. Given enough observations and over enough time, stock price movements, and our results from trading those stock price movements, will fall into a normal distribution, or bell curve. Basic statistics shows us that approximately 68% of the time, the observations from a normally distributed data set will fall between plus or minus 1 standard deviation. This is no coincidence. It maps perfectly into our expected move calculation, with the upper edge of the range reaching plus 1 standard deviation and the lower end of the range reaching minus 1 standard deviation. Therefore, as out-of-the-money premium sellers, we love to use the expected move and standard deviation markers as reference points for our trades, strategies, and strike selections. For example, if IV expands, resulting in very wide standard deviations relative to the stock price, maybe I sell a 1 standard deviation strangle and bet that the standard deviation range will collapse. If it does, that means option prices have deflated and I may be able to buy back the strangle for a lower amount than I sold it for, resulting in a profit. And if IV stays the same, we still have a much wider profit zone than we would have if we had sold a 1 standard deviation strangle in a low IV environment. In a nutshell, this is one of the most powerful aspects of tying standard deviation into implied volatility and option prices. It helps us put context around option prices and the expected move ranges they're presenting to us. Check out the written content below for more information, or proceed to the next video where we'll dig a little deeper into volatility mean reversion.